guys. Good morning. How are you doing, Kelly?
Great. How are you?
Very good too. So we are here with another episode of Let's Talk Real, and today we're gonna be talking all about FHA loans, which is I'm excited about because there's a lot that goes into this type of loan. It's a very popular loan among first-time home buyers, right?
Yes.
Yeah, so we do see this one quite a bit, and there's a lot of misconceptions and misunderstandings about it. So we're hoping to clear that up and make you guys experts into FHA loans. And if that's the loan for you, then you know what you can get from it as well. So to get started, we're just going to do a little summary. Last episode, we talked about the conventional loans, right, Kelly?
Yes.
We explained to you guys the big myth about having to put 20% down, which is not true, because conventional loans, they actually have a pretty big range of options as far as how much you can put down. You can start as low as 3% and go all the way up to however much you want to put down. And there's different things you can benefit from, to include not paying PMI, which is the private mortgage insurance, whenever you put more than 10% down. And we're going to touch base on that again today, and maybe go in a little more detail about PMI, so you guys have an even better understanding what that means, especially when it comes to FHA loans. So to get started, we're going to do the myth of the day. Yay! So the myth of the day is that FHA loans are for first-time home buyers only, and that is not entirely true. So Kelly, you maybe want to break it down what the requirements maybe are, and then we'll explain some other things about it.
So I think that the reason that myth is in place is because FHA stands for Federal Housing Administration, and they put this program in place, the federal government did, for first-time home buyers. However, you don't have to be a first-time home buyer in order to get an FHA loan. Pretty much any borrower is eligible for this product. And it was really put in place for people who have a little bit less than better credit and don't have a big down payment. And it's the requirement for down payment is 3.5%. It's easy to qualify people who have a little bit less than better credit, because a lot of the younger generations, their credit, they may not have any credit, or when they got credit, they didn't know how to manage their credit. So it's not, where it needs to be in order to get a loan, whereas FHA can step in and help with that, because they can go as low as 580 on their mid-credit score for certain people, for certain lenders, that they'll go as low as the 580. And they are also flexible on debt-to-income ratios. They can go as high as 56% on the back end. The back end includes all of your debt and the mortgage insurance and the mortgage payment that you're currently paying.
Gotcha. So we're going way into it. So we're going to try to kind of break it down for you guys, just so you understand like every single part of it. But mainly the myth was that, no, it's not just for first-time home buyers. You are allowed to even use it multiple times, and we're going to explain how that can be done. So Kelly did a great job touching base on the lower down payment option, so it's 3.5%. That is it. Of course, you are allowed to put extra, right, Kelly? And there's some benefits on doing so if you are the person that is able to do it. And the benefit, can you talk about the benefit of putting more than 10% down payment as well?
Yes. So with an FHA loan, you are required to pay private mortgage insurance and a mortgage insurance premium. If you put more than 10% down, you will have a lower mortgage insurance premium. It does get financed over the life of the loan, but that can be removed after 11 years or if the loan gets down to a certain percentage. If you were to put less than the 10% down, then you are required to pay that mortgage insurance premium for the life of the loan. So the more money you put down, the less you pay in the mortgage insurance premium, and it it will be removed after a certain time. So
Yeah.
that's really the benefit, because you know you don't want to pay it over the life of the loan. In most cases, that's what's happening because
Yeah. Yeah.
a lot of people who go into the FHA loan aren't normally putting the 10% down. But if you do put 10% or more down, then you are able to remove that from the loan.
Perfect. And then you also touched base on the credit score. So we
Yes.
know that for FHA, it's much more flexible or lenient, we should say, for buyers that are using to buy a home with an FHA. And you mentioned about going as low as 580 with FHA.
Yep. So FHA is very lenient on the borrower when it comes to their credit. So, you know, like Mimi said, there's a lot of borrowers that have a little bit less than better credit. Some lenders go as low as 620, but the lowest that FHA it will go is 580. So if you have collections on there, or I know medical collections, they don't even count them really at all, depending on what the balance is. And
that's huge for a lot of people.
Correct. And you know, they're not concerned with it because they want to get you into a home, because a medical collection, you know, unfortunately it's a medical collection. And you know, FHA is not really concerned with them. So they're going to go easy on the borrower when it comes to their lending criteria. So if somebody knows they have a little bit less than better credit, FHA is probably the program that we would want to put them into, because we'd probably get an approved eligible for them versus going conventional, which they may or may not get approved. Even if conventional goes as low as 620, they're still pretty tough if the credit isn't
at that range. Yeah, it's a little tough, and end up paying higher interest rates because of it too, because they consider it as a higher risk buyer.
Yep.
Yeah.
Yep.
So
absolutely.
Benefits. Now let's talk about the debt to income ratio, because that's something that people even don't think about it. They hear a lot about the credit score, but they don't really hear about the debt to income ratio as much. So can you explain to us what is a debt to income ratio and what are the requirements on FHA side in comparison to others?
Sure. So the debt to income ratio is your debt versus your income. So we have a front end DTI, and then we have a back end DTI. So your front end is your current debt that you have versus your income, and then your back end is your current debt plus the mortgage payment versus your income. And with FHA, that back end, we can go as high as the 56%, and that's kind of the ceiling on it. And they, you know, we take a lot of things into consideration with their debts. You know, we have to count. So if you have student loan debts that are being deferred, we only have to count a half of that balance. Okay. So if you have $1,000 student loan, we would count $50 towards as a payment versus, or not 50, $5. Is that right?
Oh, $5. Okay.
Does that make sense? Yes, because 1% would be $10.
Yeah.
I'm trying to think in my head, and a 0.5% would be $5. So that percentage is less that we have to count, but that gets put into your debt to income ratio. We have to count that in there. So any debt that you have is part of your debt ratio. And it's an important thing for anybody buying a house to kind of look through their debt that they currently have, so they see where they're at with their payments. But with FHA, if you do have some accumulated debt, there's a good possibility we will be able to get you approved with FHA having the higher back end ratio. So do you have any questions on that you would want to add?
No, I think that it's just a lot of people don't even know that that's part of their approval process, is really the lender understanding the total amount of debt versus the income they make and what the requirement is for FHA. So what are the percentages that FHA require on that debt to income ratio? Do you have that handy?
So the front end, I don't know what the front end is, I have to say. But I know the
If you
back
don't
end
remember, it's okay.
is conventional is 28 and 32.
Oh yeah, that's right. I think you remember you mentioning that.
So conventional is 28 and 32. There are some exceptions. A conventional can go a little higher with some supporting factors. Can go a little higher with conventional, but with FHA, I don't know what the front end is with FHA offhand.
It looks like it's 3143.
3143, but the back end can go as high as the 56%.
Oh, 56. So yeah, that's very, very lenient in comparison to the conventional that we just talked about last week.
Yeah.
So right there, it kind of shows already. And I know it falls in line with like VA loans too. They're pretty flexible for VA home buyers as well. But yeah, FHA definitely allows that income, the debt, to be a little higher, which gives that buyer more opportunity.
Correct. So with some supporting factors, it can go that high. And in some cases, we run our automated underwriting system to make sure if we get an approve on it, then we don't question it. We just kind of take it and go. So, so that's where FHA, so they do have their ratios where they want to be, but they do have a ceiling, and that's where the ceiling is at.
Gotcha. So we did bring it up, the fact that FHA has a double tacker on the mortgage insurance premium and the private mortgage insurance. Maybe we can try to clarify the two, because I know they're very similar, but there's some sort of differences. So, and then we can kind of explain which one goes away at some point and which doesn't. So maybe you can kind of give us some more insight into that.
Yep. So any loan, FHA conventional, unless it's 100% financing, if you don't put 20% down, you will have what's called PMI, which is private mortgage insurance.
Yep.
And the buyer pays that to protect the lender if they were to go in default. So with an FHA loan, you have private mortgage insurance. In most cases, people getting an FHA loan aren't putting 20% down. They're putting less than that. So that's what the private mortgage insurance is. And what the additional thing that FHA has is a mortgage insurance premium. So this is the one I had mentioned a little earlier. This is, you pay this as, if you put less than 10% down, you pay it for the life of the loan regardless. So on an FHA loan, you would have a base loan amount, and then you would have your FHA loan amount, which has that mortgage insurance premium financed into it. If you put more than 10% down, that mortgage insurance premium can be dropped after about 11 years. But even if you put 20% down on the property, you still pay
that insurance
the mortgage insurance premium because it's FHA. So that is something that you pay to the government that's also something that's paid to protect the lender if you were to go into default.
Yeah.
So and that's I think kind of the difference.
And one big thing that the buyer can notice the difference as well is that the PMI, the private mortgage insurance, will be part of their monthly payments.
Correct.
And it shows as a little fee there. And it will make the total of that payment monthly. But once they get to that 78% equity, right, that's when, or loan amount, I should say, that's when it drops automatically. So the PMI will go away eventually. It's part of your monthly payments. But the mortgage insurance premium, you actually pay it up front in a way because it's financed into the loan amount. Correct. So you don't see it you see it, but you don't really see it like standing out as a part of your payment. It's part of your principal in that case. And then, like Kelly says, if you pay more than 10% after 11 years, is that what it is?
Yep, about 11 years.
Whatever is remainder will drop off. But if you do not put more than 10%, which majority of people using FHA don't, then it just stays there until it's fully paid off because it's part of your loan amount.
Correct.
So it's financed into the property, the purchase of the property, while
Yep.
the PMI is just part of your monthly payments, and it will go eventually away after a few years.
Correct.
So that's really the difference there, right?
Yep. And where you'll see it is on a fee estimate. It should be, you have your base loan amount, which is the purchase price minus the 3.5%. But then you have your FHA loan amount, which has that mortgage insurance premium financed into it. So that's kind of where you'll see the difference in it, but it's not spelled out in your payment, like you said.
Yeah, exactly. You just don't see that separate line, right?
Correct.
Showing that. So, okay. So now let's talk about the home appraisal during the FHA purchase process, right? We know that one is a little more strict.
Yep.
Because it is a government-backed loan. So maybe you can give us some more insight, and I'll share my side as well.
Yes. So with an FHA loan, you have a fairly strict appraisal done on the property. So this is where an appraiser is going to come in, and they have a lot of criteria that they have to meet per government guidelines. Some examples are like no chip paint, no lead paint. So if your house was built after 1978, I believe is the year.
And then it's fine. But before 1978 is when it's a problem.
Yep. So if the house was built prior to 1978, if there is lead-based paint, that's going to be something that's going to come up. Railings are a big thing. And this would be a railing outside, going up and down steps. It could be a railing going down in the basement. It could be a railing going into a garage, because some garages you step down into.
I think any steps that have more than three steps, anything that has more than 3 steps would need some sort of railing. And if it's exposed on both sides need railings.
Yes.
If it is any staircase in the house, doesn't matter where, or even on garage, like if it's a detached garage and it has two floors, 2 levels, you would need to have railing. So they're pretty strict as far as railing goes.
And I think it's like a safety thing too.
It is. It's a lot of safety guidelines, which honestly protects the buyer in a way, right? So
it does.
That FHA appraiser goes through there not just to see the house value and make sure that the house is worth what you're buying, but also they do their own inspection, and then they're really going through safety guidelines that the FHA requires. And to kind of extend a little bit on the lead-based paints that you mentioned, if the house is built 1978, even if we can clearly see the paint is new, but it's peeling because it was like a cheap
that was my
quality paint. But if it's peeling, they will make you send it down, repaint it, just because since it's built before 1978, there's always a chance you could have lead-based paint. So they're very, very picky with that, and it can be anywhere in the house. It could be the garage door, it could be the trimming around the windows, it could be anything. Decks, any outside structures are also something they really try to nitpick on. If anything is wobbly, or if there's not proper foundation done to the property, or if the deck is not attached to the house, which we see sometimes that happen where it's not actually attached to the property, that can be an issue. So in summary, right, they are just a little more strict when it comes to FHA appraisals. And it's good and bad. Good because yes, it is protecting the buyer, making sure the house is safe and sound. It could be bad if you are an FHA buyer competing in an offer situation, because that seller most likely will not want to get an FHA loan, knowing that could be what the outcome is going to be when they accept that offer. So it goes both ways.
It does.
Yeah.
Yep.
Yeah.
So
on your end, is there anything anything at all like in FHA as well for the appraisal?
No. I think we pretty much covered it. It's mainly just being strict and so with having just an FYI for people, if most cases with an FHA loan, the appraiser, if work needs to be done, the appraiser is going to have to come out and do like a final inspection. So the borrower is responsible for paying not only for the appraisal up front, but for that final inspection as well.
That's a good
that
point.
does get added to the costs. And like I always put it on every single one of my fee estimates, whether it's an FHA loan, VA loan, it doesn't matter. I always have it on there. If the final inspection isn't done, it just gets removed. But that's really the only additional thing I would say, because pretty much I think we covered it. They're just a little bit more strict on the property for government safety guidelines.
Yeah. And then that reinspection is true. A lot of, like, I know you do that. You always already budget that you might have to have that second visit from the appraiser, because they will, if they point anything out on the initial appraisal report that any repairs needs to happen, which I think we mentioned this on one of our episodes, where home buyer inspection, there's no pass or fail, but appraisal inspection, it's sort of like a pass or fail, because if the things that they pointed out don't get repaired, then the buyer cannot get that approval. So it almost becomes a pass or fail for that buyer in particular. So if there's repairs pointed out by that appraiser, we have to rush and get those things resolved so the appraiser can come back there, visually inspect everything, make sure the things that he pointed out were done, and then we get that clear status on the appraisal portion. And that's what Kelly's saying, that second visit potentially costs additional to the buyer, and she usually just builds that in. So when she runs the fee estimates for you, she will be already taking into account that second cost, but it might not happen. The property might be fine, nothing may be pointed out, and then you end up having less cost at settlement, which is always a nice surprise to have.
Yes, absolutely.
Yeah,
absolutely,
for sure. I think the other thing that we wanted to talk about was the option to do the streamline refinancing, right, with FHA loans. So can you expand on that and explain what that is and what it means for the buyer?
So with the streamline refinance, so if this was, and I think we were talking earlier, if say you have an FHA loan and you got a new job and had to move, so you could. Is this how we were explaining this earlier?
Well, yeah. So
there's still the right thing.
Two things about the refinancing, right? So let's say right now someone is buying with FHA now and the interest rates are higher, but 2 years the interest rate drop and they are ready to refinance because it makes sense. With FHA, you do not have the cost, right? That's what the streamlined refinancing is.
Yes.
So yeah, can you break that down for us and explain what that means to the buyer?
So with the streamlined refinance,
because usually there is a cost to refinance if you have a regular loan, right? But with the FHA, you don't have that cost.
Correct. And I have to be honest with you, I'm not familiar with the streamlined refinance.
Oh, okay. So maybe I can break that down. Then I won't be able to go as in detail, but the streamlined refinance basically means that you don't have the cost to refi with FHA. So, I mean, still there's going to be a cost there because there's some fees that you have to pay, but that main fee, the large portion of it, you won't have to with the FHA. So that's why they call it streamlined. There's less cost to refinance down the line. So it's a pretty big advantage, especially now that people are buying with a high interest rate. When they're ready to refinance, it will be much cheaper for them to do so and take advantage of a lower interest rate at that time. The second thing that I wanted to bring it up was the investment portion, because a lot of people, part of our myth, thinks that they are only allowed to use the FHA once as a first-time home buyer, and that's not true. So FHA can be used as a really amazing tool for people, especially younger people that are willing they want to grow like an investment portfolio of real estate properties, but they want to start by doing primary residence to save money. So you can actually buy a house with FHA, putting only 3.5% down. You have to live in that property for at least 1 year. That's a main requirement. And then you are able to buy a second home, but then you have to move into this new home. The new home has to be a primary residence. And you can use FHA again to purchase that second home. And then you keep your first home with the FHA mortgage you already have as an investment. So now you have two properties. You moved into another one, use FHA with only 3.5% down, and then you have your first, rental property in your portfolio. And you are still allowed to use the streamlined refinancing on the previous mortgages that you have with FHA. So it doesn't restrict you on that sense. And you can keep doing that. As soon as you are buying a primary residence and you're living in that property for at least a year, you can have 10 properties, as soon as you're moving into them every time. That's really the biggest requirement. You have to be in the house for a year, and then when you buy a new one, you can use FHA, but you have to be moving into that property. So that's a lot of people do, like, especially if you're young and you're listening to this, please pay attention. Don't be renting. Go ahead and buy a house with FHA, live in the house for a year as a starter home. Then you buy the second home, keep the first one as a rental, have that income coming in. The lender actually can use your rental as soon as you have a lease signed as income. So actually that will increase your buying power, so you can use it towards the second home, and then so on until you have 10 properties. So it is a really great way to get started into investment. And then once you have enough, income coming in, you can just buy and not have to do, the moving into the properties anymore, because nobody wants to be moving every year, I guess. But it's a great way to start into the investment, real estate investment. And then keeping in mind that you can refinance FHA using the streamlined refinancing for previous mortgages. So you can take advantage of that on your investment. And it's great, because then you don't have to be putting 20% down. Because when you do buy an investment property and you're not moving into that property, it's not going to be your primary residence. There's different requirements, right, Kelly? So you wouldn't be able to use FHA to begin with. You would have to use a conventional. And what is the down payment requirement for that?
So FHA
for conventional investment.
Oh,
right?
Conventional.
Yeah.
So single family is 15%, and 1 to 4 family is 25%. But if you are purchasing an FHA loan and you want it to be a rental, you have to live in it. For one, you can't buy a rental FHA if you are not living in one of the units.
Yeah, it has to be a primary residence. But that's true, I didn't point that out. You can't buy a property that has up to 4 units. So you could buy a multifamily as soon as you live in one of the units and then rent the others.
Yes.
Right?
But
so
you have to live in one of them for sure.
Yeah. For at least 1 year.
Correct. So but the requirements for FHA, it's still the 3.5%.
Yes.
So that's where, if you're looking to purchase a rental, you can use it FHA, but you have to live in it. So that's lots of people, if they're looking to purchase rentals, then a lot of times they don't plan on living in it, but with FHA,
yeah.
So,
yeah. That's why I mentioned for younger people, or people that are willing to be in that property for a year at least. Like, let's say you don't want a home yet, or maybe you do, but you are looking for a better one, and you want to create a portfolio. That would be the cheapest way to put your foot into creating a portfolio of properties, because as soon as you're willing to be in that property for at least a year, that's the cheapest route to go. Because then, since it's a primary residence, you're only putting 3.5% down, and your interest rates are also given to you as a primary residency. Because when you are buying investment property with an actual investment financing, not only you're required to put more money down, like she said, 15% down payment, but your interest rates are usually also in a higher bracket. Yes. Because it's considered investment, right?
Correct.
So
and they will be higher with FHA too, because of it being investment. So even though the interest rates might be a little better going FHA, they're still going to be a little higher because of it being, it's your primary, but it's also investment.
Yeah.
If that makes sense.
Yeah.
So
exactly. Yeah. So I guess, do you have anything else to add in that sense?
Not anything to that. And thank you for taking over my streamline refinance. I've never done
don't worry.
I've never done one. So Because if I do one, then I know the details of it, but I've never actually done a streamlined FHA refinance. So
Okay, I'm not expecting you to know everything because there's so many different products in the financing world. So if you knew all, I would be like, oh my goodness.
well,
So
I feel like maybe that should be one I should learn.
yeah, and then I'm gonna bring one up that I know for sure you don't know much about it, which is okay. But I just wanted to make sure that the people that are watching know that this is an option. So let's say you already have a home with FHA for many years, or maybe you're just getting it, but just for your to be aware, there is something called a reverse mortgage, where you can tap into it. Let's say you own it for a few years, so you have built enough equity, your loan amount is pretty low, and now you are like older, pretty much in retirement, and you need additional funds monthly. You can actually create what's called a reverse mortgage, where the bank is going to pay you back on a monthly basis out of your equity that you built on your property. So if you bought a house for $200,000 and then you have built $100,000 equity, you can actually do a reverse mortgage, and then from that $100,000 equity that you have, you get paid monthly from the bank, and of course it takes away from your equity, but you get paid extra monthly. So if you are already a senior citizen and you want to take advantage of that, you can. And I just wanted to make you guys aware that you are allowed to do that with an FHA loan, because a lot of people think that reverse mortgages only can be done if you have owned the house free and clear, so meaning you have no mortgage anymore, or if you have conventional loans only. And that's not true. You are allowed to tap into that reverse mortgage at any point. It's just that you can only take advantage of the equity you built. So if you haven't built too much equity, that means you're not going to have reverse mortgage for too long, right? But if the more equity you have, the better it is. So that's why I think that's a myth as well, or a misunderstanding that you have to own the house free and clear, and that is not true. You could still have a remainder mortgage and still be able to tap into that reverse mortgage as an option. If you never heard of that, there it goes. This could be also a way for you to prepare for your retirement and have additional income on a monthly basis. And I have a couple people that I know that are currently doing this, and that's why I'm aware of the reverse mortgage as an option, because it does assist a lot of people that maybe depending on Social Security only. This could be a huge thing, even for yourself to prep for the future. I mean, if you have multiple houses or just the one house, but still you can do a reverse mortgage and get paid out of it. And then what happens is once you pass away, the family can take over. If there's still equity on the property, they can sell it. If there is no equity left, the bank is probably just going to take over and sell it as a bank-owned property. But that's an option. That way it's something you built and paid for your whole life, and you can tap into it for retirement. That's why real estate, it's such an amazing investment, because it can give you now and it can give you later. And it keeps on giving because you can leave it for your family as well. So there's a lot of advantages of owning real estate.
Yes, absolutely.
Yeah.
So there's one more thing that you didn't mention, and it's a pro for FHA.
Also, do you want to do like the pro and cons so we can summarize everything?
Okay, well, we can do that.
I just want to start with this one before you forget.
So with an FHA loan, you can get 6% seller assist. So
huge one. I'm glad you brought that up.
I completely forgot about that. Whereas with, you can get 6% with a conventional, but you have to be putting more than 10% down.
Correct. And then you're capped at 3%. I think we mentioned that last episode, right?
Yeah. So, but with FHA, you can get 6% regardless of how much you're putting down. So that was one thing I just wanted to quick add. Now we can go to our summary with our pros and cons.
Yeah, and then just to extend on the seller's assist portion, right? So just so you guys have an understanding, the seller's assistance, not something is guaranteed. It is a negotiation piece. Your buyer's agent can try to negotiate that on your behalf with the seller's agent, and you can try to negotiate up to 6%. It may be tough to get the full 6% sometimes, especially in today's market, but that is available. depending on the property and the situation. But it is definitely a huge pro when it comes to for buyers that are with limited budget or limited funds, to assist with that down payment and closing cost assistance. So that is something that we can negotiate with the sellers, up to 6% with FHA loans. But yeah, so pros. We're gonna just do a summary and we're gonna break it down between pros and cons for FHA. I'll do the pros, you do the cons. What do you think?
Yep.
Okay.
Good to me.
So since I started with the 6%, the second pro would be the lower down payment. That's the 3.5% requirement. It's definitely one of the lowest. I mean, we do have conventional loans that are 3%. So FHA would be the lowest, the second lowest one that I know, unless you're going 100% financing like a VA loan or a USDA loan. Which, by the way, our next episode, we're going to be talking about USDA loans, and they are 100% financing. So we're going to explain to you guys how that works, who can apply, and where it can be used, because there's some differences in that. So that's going to be our next to come. So another pro is that the credit score requirements are more flexible, right? So it's not as strict as other loan types. So you are able to go as low as 580, depending on the lender you're working with, right? Because their lenders might have their own requirements. So that's why it's good to talk to more than one, maybe sometimes, especially if you're in that bubble. But FHA standards are 580 or higher. So just so you guys know. The debt to income ratio is pretty flexible as well. Conventional loans are usually, I think the max you can go, it's 42, while with FHA it's up to 56. That's like the max ceiling that you can go up to. And you have the streamlined refinancing option that we mentioned, so it's low cost to refinance when it comes the time to do that. And you can buy multiple homes as soon as you leave in that home for at least 1 year at a time. You can ever buy 2 homes at the same time with FHA. So that's something you need to understand. You have to buy to live in. But as soon as you live in it for a year, you can buy a second one, live in for a year, third and fourth, and so on. So it's a great way and a cheaper way of building a portfolio if that's your goal. And you can use FHA loans for up to 4 units. So if the property is a multifamily property, you can still use FHA for up to 4 units as soon as you're living in one of the units. And I think that's it for the pros.
Yep, I think you covered most of them, if not all. So the cons with an FHA loan. So to start, you, just like any other loan, if you're not putting 20% down, you will have private mortgage insurance.
Yeah.
And but with FHA, you also have a mortgage insurance premium. And the mortgage insurance premium is something that it's financed into the loan. So you have a base loan amount, but then you have your FHA loan amount that has the mortgage insurance premium that's included in with that. It's not broken out on your payment. It's just your loan amount's a little bit higher, and that's how it's financed. However, if you put more than 10% down, that mortgage insurance premium will drop off. Usually takes about 11 years. If you put less than 10% down, which in most cases, people who are going with an FHA loan is because they don't have the 10% to put down.
Yeah.
You pay the mortgage insurance premium over the life of the loan. So that's one of the cons. The next one would be FHA is very strict on properties. So when an appraisal is done, it's marked as an FHA appraisal. They're going to be looking for, make sure a staircase, no matter where it's at in the house, needs to have a railing. They want to make sure that if the home was built before 1978, they want to make sure that even if it was repainted, they want to make sure that there's no lead-based paint in the property. Any chip paint, they don't want to see chip paint. So they're very, very strict on the property as a whole when it comes to an FHA loan. And with that being said, sometimes it's tough to purchase a house if you're just looking to purchase a starter home that may need fixed up. That might not be the best. An FHA loan might not be the best route to go if you're looking for a starter home that needs some work done.
That is true.
So I would say those are the two biggest cons with using an FHA loan is the mortgage insurance premium. So you are paying a little extra up front on an FHA loan, and the appraisal restrictions, which if work needs to be done, you also have to have a final inspection, which you, the borrower, will have to pay for. So I would say that.
And that brings it up to like not being as competitive too.
Yeah.
Because of those more stricter guidelines.
Especially in this market right now. So market's cooling off a little bit, but the competition is still out there. And
tell me about it.
So if you're in competition with somebody who's just going conventional, most likely you're going to lose that battle. But
yeah, unless your terms are excellent, and if you ever need to check on how to make your offer more competitive, we have an episode for that, and we explain the different things you can do to become more competitive. And it's not just about price, right? So the terms of the offer can make it or break it for you to get that offer accepted. But having a conventional loan sometimes gives you a little bit of an edge because of the stricter guidelines of the FHA.
Yep.
And that's a big one.
Yep.
Yeah. And we know that there is a limit on the loan amount for FHA.
Oh, yes.
I don't know if our area here in central Pennsylvania, if that would become a con, because it's considerably high. It's almost 470 some thousand.
Yeah, 400. So there is a loan limit, because a lot of people think that they can't get an FHA loan in the higher amounts. So the floor of FHA is $472,030.
Yeah,
that's kind of that's a decent amount.
That's a decent amount for our area, right?
So the ceiling. So in some other states that offer, FHA is offered pretty much everywhere. Probably like California, for example, theirs is $1,089,300. So where their home prices are higher than Central PA, so their ceiling is going to be that $1 million mark. Correct. And so you can get an FHA loan here in PA up to the $472,000. So, which is a pretty decent amount.
It is pretty decent, yeah. And what we see is that usually, people that are using FHA, they are first-time home buyers, and we don't necessarily see first-time home buyers going straight into a $500,000 home, right? So I think we're pretty good in here in our area, because you can get them almost like I mentioned at the 400 range already. So it's a pretty reasonable amount. Mm-hmm. Maybe some other states might not think so, but for PA that works great, because I don't think necessarily is a con. For us, it's just fine. And I think but it would be considered a con because it is limiting the buyer at that 472 for our area here.
Yeah. So it could be a pro and a con, depending
where you are.
Where you are, but I feel like the average purchase price in Central PA is probably 200.
It's actually 236 as of past year.
What is it?
236.
So yeah. I said 200, 250.
Yeah, you're pretty good. 250. That's usually where we are. Yeah.
Yeah.
No, yeah. So I think that's it for today. Do you want to add anything else, Kelly? You're good.
Nope, I don't have anything else.
Okay, so this is it. If you guys have any additional questions, maybe something that we were not able to clarify and you got questions on, please let us know. We have our information going on down here at the bottom, so please feel free to reach out. You can also message us on social media, any of the ones that you might be watching us from, and I will be happy to get you sorted out and answer any questions you may have. So thank you so much, Kelly. Hope you guys watching have a great day, and we'll see you next episode where we're going to be talking all about USDA loans.
All right, see you later.
See you guys. Bye-bye.